What's up, guys? For today's video, I'm gonna hit on something that's really important. Not exactly the most fun part of trading, but it is very crucial in terms of becoming a profitable trader, and that is risk management. I'm gonna divide it up into three key sections, and those being stop loss, scaling, when to take profits, stuff like that, and then sizing. I'll also go over how I play gap plays to kind of get an understanding of that. There's no one real way to play a gap, but this is how I found a way to play these gaps consistently. I want to first start off by saying, risk management and how much risk you're willing to take, it really depends on the person. Some people are more adverse to risk, so they're willing to put more in. Personally, I use a 10% hard stop loss, and this is just because it helps me with that discipline piece that I really struggled with early in my trading career, and being able to respect this stop loss, right? And one thing that is really important, and I keep in mind a lot, is we can always re-enter into a play, but we can't get that money back. So that's why I really stick to my stop losses, and it's something I'm really thankful that I learned the hard way. While it sucked, it really has changed my trading career. When it comes to respecting our stop loss and having a stop loss, right, I think it's really important because we can get these gains back, right? But we can't get that money back if, say, we don't stop out and we just keep chasing down. One way we can really think about this is we can recover that small loss, and we can wait and see if that play bottoms out before re-entering in, and then we can recover those losses and get some more gains. So that's one thing keep in mind when trading, is it's okay if that stop loss hits, right? But at least we have that risk management in place, and it also helps with the mental side, which I think is something really crucial that risk management does help with. When I talk about the mental side of trading, I have a video over it, but whenever I go into the play, I'm gonna plan out where I'm gonna scale. I'm gonna assess what strike price am I gonna play, where am I gonna enter, and what am I gonna use as confirmation once we enter, and then what levels am I looking for next, right? A big way I do that is through the use of unusual whales. I use that to select my strike price, look for those potential big plays, and then I go over to my charts. I use the 15-minute and the hourly chart to really look through big levels for day trades. Reason I do this is the 5-minute and the 10-minute usually are going to give us very small ranges, and I can use those for scalps, right? But I want to use the hourly, 15-minute, and even the daily more as to know, where am I going to day trade this, where are the potential ranges, and then look at possible places to scale. Thing to remember with that as well is the bigger the time frame, the more significant of an impact these levels will have on the overall ticker. In terms of a stop loss, I use a 10% hard stop loss, and the reason being there is that's what I'm looking for in a play. Is I'm looking for something that's going to give me 2-to-1 upside. Stop losses really depend on a person, as I stated earlier, but I like that 10% hard stop just because most of the time if you're wrong within that first 10%, this play is going to tank down to about 18-20%, and those can add up over time, right? We need more big wins to really get over these losses. As terms to 10%, I can start adding up, those 20% pay off, those 10% base hits that we get, they start to add up and pay off, and I can really manage my risk a lot better when using that hard 10% stop loss. So that's something that's for me. The first thing I would do when going about setting a hard stop loss, I would think about how much am I willing to risk here? What is my position sizing, and really think through that. And it's going to be different for everyone, right? For me, it's that 10% hard, and it's something that I've really developed into my system, and it's helped me a lot become profitable. An example of this is SPY from Friday. So say I enter here, right? I have this key level. It's double bottom, almost triple bottom here. I enter. I wouldn't enter on this candle per se, but say we do enter here and we get stopped for 10%. Okay, let's reassess. I want to see a retest at 434 level. We do get the retest, close above, and then a bounce here, right? If I have a hard 10% loss, I'm stopped out right here, and I can really reassess my position. We get that reclaim, we're above VWAP, we get a retest, and we can enter again. Those 10% gains, they're quickly gone, and we start making profit back off those gains. A nice push here throughout the day. So I like that a lot when it comes to risk management. One big thing I talk about frequently is compounding these small gains. The base hits add up over time. Conversely true, these small losses, they add up over time. I can much more easily overcome those 10% losses than I can multiple 20% adding up. So that's something I like a lot about that 10%. And as I said before, it really depends on how much risk you're willing to give. The question was asked about, lower premiums. I also use a 10% stop loss on premiums that are lower, and the reason being, I want to implement that in my system. I treat them the exact same way. The only thing is, I can size in maybe heavier or smaller depending on how confident I am in the play, and then I can really practice that scaling that I'll talk about here in a second. But other than that, I play low premium, high premium, doesn't matter. I play those the exact same. The good thing about low premiums is oftentimes they won't move as fastly as do the larger ones. So on a stock or a ticker like SPY, these premiums move super fast. So if you don't have a really good entry, this can turn on you really fast. Same goes for the AMDs, the Nvidias, Facebook, Microsoft, Teslas of the world. Same thing there. So I'd say it's a little bit easier to manage our risk when there's a slower moving premium, and that's the reason I like focusing on smaller account plays where the premiums aren't as high, because if our entry isn't exactly perfect, these tickers usually don't move as fast in terms of the premium. So this is something that I really like when especially building that small account. The next thing when it comes to risk management is sizing. So for me, I only risk or size 5% of my account no matter the trade most of the time. If I have a very high confidence play or a ticker I'm really confident in and know how it moves, I'll use about 10% max, and that's just being, if I do risk that 10%, get the 10% loss, I'm risking 1% of my account maximum. For me, a ticker like that is NEO. Most of the time my plays on NEO are about 10%. I've been trading it a lot recently. I like how it moves. Premiums are pretty cheap, so that's something I like a lot. It respects support and resistance. I have a video over what I look for in when I'm learning a ticker, if you want to check that out. But NEO's one where I'm a little bit more confident. I know the ticker pretty well, so I do size in a little bit heavier. But most of the time I use that 5% on any trade. If it's a lotto, I'm going to use 1% of my account. Very small sizing, as most of the time I'll let that run pretty low before cutting it. And that's something I usually only play on Fridays, maybe in earnings, but of recently I haven't been playing earnings just because the market's been pretty bearish. We get pretty good earnings and tickers are still falling the next day. So I had never really had a confidence in that of the past week. Maybe with the way the Apple and the earnings went there, SPY's starting to pick up a little. Earnings plays are something I look more into, but I would only go about 1% on lottos, earnings plays, stuff of that nature. The question was also asked about fills, and fills are definitely hard and very crucial when it comes to options, right? And that's where I think learning a ticker really comes into play. Learning the bid-ask spreads, are these spready or are they not? For me, why I like NEO so much is because the spreads are very tight, usually between 0.01 and 0.03. So even if I don't get the best fill out there, it usually pays off pretty well. When it comes to the actual fill type I use, a ticker where the spread is pretty tight, pretty concise, I'll use a market order on that. When it comes to a more spready option, most of the time I'll use a limit, just because if I enter on the ask on a spready ticker, I could be down 10-15% right away. My stop loss is hit, and then it rebounds or goes whatever way I expected. But it doesn't matter because I got stopped out, lost money really fast, and that's something I think that we can really learn and look into before going into the play. Know the bid-ask spreads and understand what type of order am I going to take. This can really help us when it comes to not only planning our trade, but also knowing the risk management aspect, as well as being confident in our play. We want to be pre-prepared for the trade, and when it comes to trade day, all we got to do is execute, right? So that's something I like a lot, especially when it comes to planning, and a big reason why I like watch lists so much, as well as learning 3 to 5 tickers I could trade any day. Doesn't matter market condition, anything like that. I really know these tickers and I'm comfortable with them. Another thing when it comes to fills or entries, right, is If I'm looking to enter into calls, I'm looking for these long lower wicks off of key levels that I've already determined. So this ticker here would be NEO, long lower wick, nice volume after a big volume bullish candle here. Bullish engulfing 3 candle, gets denied by VWAP, retests and holds, and then ultimately bounces. When it comes to entering into calls, I'm looking for that long lower wick with the close above a predetermined key level, and then from there it's all about managing the trade. And this is how, scaling that third piece of risk management really comes into play. For me, I personally like to scale at the 20%, and I also scale in thirds. So for me, say I enter in here, I'll probably get that 20% around this level here, so I'm a third scaled out. Another thing with that is, let our stop losses do the hard work for us. Let it take all the thinking out and respect these stop losses, as they can have a very, very good impact on our mental game and trading overall psych. As I just mentioned, I scale in thirds, right? My first target being 20%, my second target being the next big resistance after that, and then the last third I'll scale or use as runners, adjusting my stop loss up. So in terms of stop loss, I have a 10% hard stop loss. Once I get to 10% profitable, I'm moving my stop loss up to break even. This helps me, just not lose on big trades, stuff like that. At least I get that break even point, right? Once I get to 20%, I have that third scaled. I'll move my stop loss up to 10% so that I know, I'm taking profits no matter what on this trade. And then I'll keep adjusting that stop loss up. At 20%, I'll move it to 10, 30%, move it to 20, so on and so forth. Once I just have runners left, I'll adjust this up to the next big resistance point that needs to turn into support, put it right underneath that, and then let it run, right? Let it do its thing. The next question that was asked, do I size up? And most of the time I do not size up. And I don't really have a great reason for y'all in terms of why I don't size up, but in high confidence plays, where, say this 20.43 right here would be my entry point, I could enter here, and then once we see this long candle here with a retest, I could size up there. The only way I will size up is if I do catch a breakout at a very good level. Say, it's 20.43, I enter right here on this 24.3, and then we get this candle that closes above. Cool, I'm nice there, and then I can enter on this retest here. And then, we get another retest as well. But that is one way I will size up sometimes. But most of the time, I keep my full position off the jump, and I never size down. I think that's something really, really big, not only for managing our risk, but also for our psyche, is I'm not going to chase something down, right? I can always re-enter into these plays, and that's something that has really helped me a lot as well. In terms of playing gap ups and gap downs, one thing I always do is wait on a retest. So for NEO, my put level was 20.8 on Friday. We opened below this level, never really got a full retest. So I ended up not playing NEO on Friday just because, we didn't get that full retest. I wasn't fast enough here. So my risk to reward wasn't really as measured out, and I didn't like not really knowing exactly where this could turn, right? When it comes to entering into a play on the retest, if I want to enter into puts, I'm looking for a long lower wick, some nice volume, and we're still closing below that level. In terms of a gap up, say we have, this play right here on NEO, it gaps up to 20.8, which was the put trigger. We get this close here. We get this close here on a retest above our 20.8, a nice little lower wick. I will enter into a play here on a failed call or put trigger, but I'm basically looking for the same things. I also don't adjust my levels to pre-market highs or lows, and a reason being is I really just want to see these plays retest, and I also don't like the risk to reward up there, so I'm going to wait on the retest. If we get a failed retest, say it's a gap up and we fall through the level 20.8 here, end up falling here, I can play the inverse of that. So if this is a failed call trigger here, I can play puts off of that. If the opposite's true, if it's a failed put trigger, I can play calls off of that on gap ups or down. But the main thing being there, when it comes to gap ups, I'm waiting for a retest, and I don't adjust my levels. So I also can play failed call and put triggers on a gap up or a gap down. My big reasoning being there is the risk to reward ratio. I don't want to chase something too high. If a play, gaps up insanely and doesn't retest a level, I'm just going to let that go. Don't want to fall into the FOMO. I think it creates bad habits. And also, most of the time, I feel like we get pretty lucky if that play ends up playing out in our favor. While risk management isn't exactly, the sexiest part of trading, it is honestly, and in my opinion, it is the most important part of trading. And the reason being, it helps to control our emotions, which is the overall hardest part of trading, in my honest opinion. But it also helps us when it comes to protecting our capital. And that's the most important part is, being able to trade the next day. Take green when we see green. Those base hits add up. Have a proper stop loss. Some ways that we can really practice this and get better at it is pre-planning our trades. Big reason why, I mentioned earlier, why I like watch lists so much. What strikes am I going to play, right? I use unusual whales to do that. I have a video on it. Where am I going to scale? What levels am I watching? A key level close above or below. In terms of day of the trade, I always trade here on the 5-minute. Wait for 5-minute close above or below, while also using the type of candle to really help with my confidence. In terms of call, I'm looking for that longer wick off of a key level. And puts, I'm looking for a long upper wick off of a key level in denial. Getting to learn some types of candles is very important as well. I have just retweeted a thing by Young Iverson Trading that really goes over the importance of keys. It's a little cheat sheet to candles. So that's something also can be referenced or saved. I have it saved, printed out, put on my computer. But really helps me when entering into a trade with high confidence, what I'm looking for, and knowing what levels I'm going to scale at, what my risk management is. Another really important thing that when it comes to pre-market and our pre-trade plan is assessing, is this ticker going to gap up, right? In pre-market, we can see if it's going to gap up or gap down. And then we think, how am I going to play the gap? What levels am I watching? What kind of candle close do I want? And what am I going to do once I'm entered into this trade? Another thing when it comes to stop losses is we don't always have to let that 10% hit. Say we enter a play right here, we enter puts on this close below a key level we identified at 20.8. The next candle, we see some nice buying up, inside candle, and then they keep going up. And maybe our 10% stop loss hasn't hit. We see that a lot of buyers have been stepping in, pushing this level down here, some bottoms forming off of another key level earlier. So it's okay to take that out and reassess the position before the actual stop loss hits. This is something that I struggle with to this day here and there, is just being in the mindset that I have to have my stop loss hit, right? If I see something that's not playing out, candle types start changing, buyers step in if I'm in puts, or sellers step in if I'm in calls, I can enter in before my stop loss hits. I can also take profits before that 20% level hits. It's really just a way for my mind to think and be able to process it. So I plan that out, the day trade above, and then the day of the trade, I'm going to use those candle types to really go through and assess where I'm going to exit, where I'm going to enter. And if things don't turn out the way that I necessarily planned them, I'm just going to use the candle type, right? Most of the time, we let our emotions and everything that's happening so fast really get up with us. So we got to, work on trading what we see in front of us, the price action, the candle type, where are buyers and sellers stepping in. So I like this a lot, and it's something that I really like to incorporate into my system when it becomes the day of the trade.